What are private equity and hedge funds? Who are the investors? Private equity firms and hedge funds pool money from institutional, accredited investors, and retail investors. A retail investor is an individual or non-professional investor. Institutional investors are companies or organizations that invest money on behalf of other people. Institutional investors have the distinction of oftentimes buying or selling large blocks of stocks or bonds, often called whales, on Wall Street. Examples of institutional investors would be mutual funds, pension funds, and insurance companies. An accredited investor would be an individual licensed as a professional investor. There's a financial and professional criteria. The financial criteria is to have a certain amount of net worth, and the professional criteria is to be licensed through FINRA through a Series 7, 63, or 82. A business entity or a fund can also be an accredited investor. Essentially, an accredited investor is an informed or educated investor. Buyside business models. In the private equity business model, an investment fund is raised with limited partners committing capital to a fund. Capital is called as needed for investments into companies that become portfolio companies. The example life cycle of a company for a 10-year fund would be 4 years to invest and 6 years to harvest returns. In the hedge fund business model, an investment fund is raised with limited partners committing capital to a fund. Capital is either in cash or called, depending on the fund raised, for investments as minority stakes into public companies. Investments into and out of positions may be quick. How do private equity and hedge funds make money? Many of you might have heard the 2 and 20 rule. Funds charge a management fee on assets under management and a fee on capital gains. The 2 and 20 were referred to a 2% management fee of assets under management and a capital gains fee of 20%. The industry has changed over time, and now 1.5 and 15 may be the norm. What is private equity? Private equity firms are investment partnerships where pooled assets are used to buy and manage companies before selling them. The idea is to use debt to buy an asset that is more expensive than the cash you have on hand. This is called using leverage. There are various strategies to private equity: VC, growth equity, buyout, and distressed private equity. This basically refers to the different stages of the life cycle that a private equity firm is willing to invest in. Generally speaking, the most common type of private equity firm will focus on the mature stage of companies. And the reason for this is because mature companies will generate steady cash flows that help to pay down the debt that private equity firms raise to acquire the companies in the first place. But note, there are pros and cons to investing at each stage of the life cycle. Private equity firms generally use leverage, and in order to buy these large companies, the private equity firm may only pay about 20% of the company and the rest coming from debt financing. It's important to have a good relationship with the investment banks, as the investment banks provide the debt for these leveraged buyout transactions. Note that debt is a double-edged sword. They can be used to increase returns, but too much debt could bankrupt the portfolio company that the private equity firm has acquired. Returns are calculated in many ways. IRR, NPV, or MOIC are some of the more common metrics you'll see. IRR stands for internal rate of return, NPV stands for net present value, and MOIC stands for multiple of invested capital. The private equity ladder. In private equity, you generally start out as a private equity associate after 2 to 3 years of investment banking. From there, you do 2 to 3 years as an associate and or senior associate, then business school, then post-MBA associate or vice president, director, and then managing director. Deal teams in private equity are generally skinnier than in banking. As in all business pyramids, it is hard to reach the top. This is especially true in private equity. In order to be a managing director, you need to bring in deals that generate returns for the funds. To be considered a good managing director, you have to close about 1 deal a year. And as an associate in private equity versus investment banking, you may not see a deal close during your 2 to 3 years as a private equity associate. You will likely pass on some not so great opportunities or ones that don't fit your firm's investment criteria. For those that you do bid on, there's multiple buyers and only one seller. Therefore, the odds may be against you to complete a deal during your time as a private equity associate. What are hedge funds? Hedge funds are structured as a limited partnership. It's still a pooled investment vehicle and generally require a high minimum investment or net worth from accredited investors. Hedge funds generally have shorter investment periods and lockup periods versus private equity firms. Here are the most common hedge fund strategies: long-short equities, credit strategies that include distressed debt and long-short credit, global macro, which includes fixed income, commodities and currencies, and quantitative strategies. In order to sum up anything on the buy side, whether that's hedge funds or private equity, the argument is basically, how do you define buy low, sell high? For hedge funds, it's value versus growth investing. Companies that have higher growth are generally more expensive. Growth companies refer to investing in more expensive companies, whereas value investing refers to investing in less expensive companies. Growth has higher risk and higher reward. They're more expensive, but the higher growth should compensate for that higher expense nature. There are successful hedge funds in each category. For example, Tiger Cubs invest in high growth companies versus Warren Buffett that invests in more value-oriented companies. At the end of the day, it's just buy low, sell high, and be successful at it. The hedge fund ladder. Hedge funds are generally very lean. They're different from private equity and investment banking in that there's not the same breadth of team. For most funds, there's generally one analyst covering a sector or two for each portfolio manager. In other words, if a portfolio manager covers only one sector, they may have just one analyst working for them. Larger funds may have more titles just to differentiate everyone, but generally speaking, the portfolio manager is the highest title unless you become a partner of some sort, which is essentially the same responsibility, but with now equity invested in the fund. Single book funds versus pod shops. The pod shops tend to be very specific. It's usually one PM covering a sector or sectors with a few analysts supporting the PM. The hedge fund will have many pods, each pod generally serving a certain product or sector. The pod shops trade more frequently, especially around quarterly earnings. Most pods covering industry sectors are market neutral, meaning that the value of their long positions equals their short positions. Single book funds. For these funds, a hedge fund manager generally runs one book. There are several PMs, of which each will have an analyst covering a sector. The PMs and the traders decide on which investments go into the fund. The fund is looked after by the hedge fund manager and/or chief investment officer, and each PM is responsible for their positions in the book. The differentiation here versus pod shops is that for pod shops, each portfolio manager is considered to have their own book, versus for a fund manager, everything is considered a single book. Like, comment, and subscribe for more content. Also, visit our website at www.wallstreetsmart.com for additional resources.